Hello, chart watchers, and welcome to this Friday, September 28th Market Watchers live show with your hosts, Tom Boley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, you can see the Dow Jones Industrial Average trying to put in some gains to close out the week. Currently, the Dow is up 46 points. The S&P 500 up a little more than 2.5. The NASDAQ up 8 points. And finally, a little outperformance by small caps today, up 7 points, getting close to that 1,700 level. 10-year Treasury yield continues to drop after testing that May high, which was also a 7-year high, up at 3.11%. Literally hit that level to the T and then came back down the last few days with the Fed announcement. Obviously, a lot of it already built in, a lot of the expected rate hikes built in. So we are seeing a pullback there. Volatility index continues just to meander between 12 and 13. It is up about 1% today. Utilities, with that pullback here in the 10-year Treasury yield, we're seeing a little bit of a rebound in the utilities. I don't think that'll last long, but at least for now, we are seeing some strength in that area. Energy also having a really nice day today. Once again, trying to move up into that area where we have struggled at 77. We'll see if we can get through. The XLB materials on the other end of the spectrum. Take a look at both materials and financials. Over the last 5 or 6 trading days, they have both taken a pretty big hit to the downside and now are challenging some pretty interesting support over the past couple of months. On the positive side of the ledger, NVIDIA had its price target raised this morning. I know Erin will be taking a look at that chart in a little bit, but NVIDIA enjoying a nice day today, up $11. And the SEC has come down on Tesla. The Tesla CEO, Elon Musk, is being sued for his tweet about taking Tesla private. And Tesla, you can see, down $36 today. So rough day there. But Erin, it is the end of a trading week. It's the end, actually, of September, last trading day of September, which not only is the end of the month, but also the end of the quarter. So a lot going on today.
Definitely. Lots to digest as far as the market is concerned. I know you've got seasonality. You're gonna talk about October. What is that on Monday? So that's going to be great. And I'm getting all my monthly charts together this afternoon after the close, so I'll have all those ready. But I know Carl's going to be writing about all those monthly charts in the Decision Point blog today, so hopefully everybody will go check that out.
Yep, and with the seasonality, I know last week with my workshop, I did the combined seasonality and drilling down, but I did it for the entire fourth quarter. So it wasn't just October. So the difference on Monday will be I'm strictly focusing on what's hot and what's not in during the month of October. And speaking of what's hot and what's not, we do have Mary Ellen McGonagle with us today. And Mary Ellen, how are you doing this morning?
Oh, I'm doing wonderful. Thank you. Yes.
Yeah, you get to come on and share with us what's hot, what's not as we close out September and get ready for what typically is a pretty bullish fourth quarter.
Yeah, and it was another interesting week. So we'll have a lot of interesting areas to cover and drill down to some neat looking stocks.
Yeah, even that chart I was showing, I probably gave away some of your thunder there with materials and financials having such a rough week. The last 5-6 trading days, they've just can't seem to find a floor. But I'm sure we'll drill down into some of that in just a bit. So hang around with us if you don't mind.
You bet.
I'll bring you back in just a bit. Okay. Erin, why don't you take it away?
Absolutely. All right, what do we got coming up this coming weeks? As I said, seasonality on Monday. I've got the monthly review Tuesday. Charlie Kirkpatrick will be with us on Wednesday. We haven't heard from him in a while, so that'll be a great show, I'm sure. Today's great show, though, lined up. Of course, we just introduced Mary Ellen. She's going to be doing her What's Hot, What's Not segment, 10 and 10. Our first symbol is SeaWorld Entertainment. That was a request that came in through email. And then finally, I will finish with that sentiment update. You can see what investors are feeling and also what they're doing with their money. So that'll be a very interesting segment for you at the end of the show. But let's go ahead and get started. Top of the show, of course, technical news and headlines. Oh, lost you there for a moment, Tom. I know.
No, I'm back.
Okay.
Let's take a look at the economic reports here. You can see August personal income rose 0.3%, which was just a little bit below expectations of 0.4 of 1% gain. August personal spending came in as expected at 0.3% increase. September Chicago PMI came out about 9:45 Eastern, and that was a disappointment. Came in at 60.4 relative to the 62.3 that was expected. And then finally at 10 a.m., another miss. We had September consumer sentiment come in just slightly below expectations at 100.1 versus 100.8. And all of that, what has happened? Well, like I said at the top of the show, we have seen the Fed come out. They've talked. They've given us their policy statement. You can see the 10-year Treasury yield had moved higher into that meeting. And then once the news hit and they, said what they had to say, which wasn't a whole lot except just taking out the word accommodative, we have seen a pullback in the TNX. So we're just seeing what I consider normal rotation back into Treasuries. I do expect eventually we're going to get back through that 3.11%. But it's hard to say how far we pull back before we do it. We have been trading in this sideways range for a bit. I would say because during the consolidation, we really struggled to get through 3%. And you can see that 20-day moving average is rising and up near that 3% level. I think that's going to be an area that we're going to really want to watch. Let's take a look at Tesla here, because Tesla, as I mentioned, Elon Musk is being sued by the SEC. And the stock has gapped down, and outside of I guess this was September 7th, when we went down below 275-ish. This is really the first time we've had this a move this low, besides that September 7th day, since back in April. So this is a pretty significant move to the downside, almost 12%. And I think just about everybody scratched their head when Elon Musk made that tweet, because you just can't manipulate prices like that. And I think that's what the SEC is saying here. You just can't manipulate prices. NVIDIA, I know you're going to get into this one in just a minute, Erin, so I won't talk too long about it. I did want to just show a relative chart of it, though, because this is a stock that's been going up despite its industry group, which over the past few months has been going down. So you do have one of the better stocks in semiconductors in NVIDIA. That's what the market is telling us. And now we get an upgrade. Well, not an upgrade, but a raised price target to 400. And I think that's the first one on the street up to a 400 level. Stock's only trading at 280 or just below 280. So 400 price target is pretty bold and aggressive. Then I want to also mention, I'm going to look at a couple other relative charts in just a minute, but I did want to pull up the UUP, because this is the proxy for the dollar. And you can see it had been kind of struggling in this sideways configuration. But as I mentioned in my blog, we are breaking out of a island cluster reversal off of this downtrend. You can see we had this little cluster down here a little bit below 25. We broke out of it with a gap up yesterday, continuing that move. And it's been about 5 to 6 weeks since we've moved up above about 25.40. We got as high as 25.31 earlier. So we'll need to see if we can clear this overhead resistance. If we do, then I think we'll probably have a clear shot back to the high we saw in August. Now, what's important with the UUP is that it has a pretty good impact, or a big impact, on how small caps perform. So if you look at this chart, it's not going to line up exactly, but I think when you see the dollar going down, you generally are seeing the Russell underperform. And when the dollar is moving higher, we tend to see the Russell 2000 outperform. There was a little bit of a disconnect here for a couple of months, but as we've been pulling back, you can see that this Russell 2000 has been underperforming. But now we got the dollar moving back to the upside. And you can see today just starting to get a little outperformance. I think this could have some staying power, especially if that dollar does make that break above 25.40. So it's something to at least look for. Getting back to those relative charts, and this is why I think technical analysis is so important. Yesterday, Bed Bath & Beyond, BBBY, came out, and they reported revenues that missed. They missed by a mile on their bottom line, 36 cents versus 51 cents. And then they completed the trifecta and guided fiscal year 19 EPS lower. So, they basically couldn't meet their revenue expectations, couldn't meet their earnings expectations, couldn't even get close to those, and then lowered their guidance. Now, I want you to look at this Oh, let me get this on a relative chart. I'm sorry. So if you take a look at this, first of all, you're in the specialty retail group. And we have talked about this many times, how strong this group has been moving to the upside. But Bed Bath & Beyond has been moving lower throughout most of 2018. And when you look at the relative chart, even before what happened yesterday, you see a stock that on a relative basis is wildly underperforming its peers and also underperforming the S&P 500. And I mention all of this, and by the way, the group overall has been uptrending relative to the S&P. And I mention all this because when a company comes out and reports bad results, if the company has been trading down on a relative basis, I think that's a pretty good indication that the numbers probably aren't going to be great. You have to remember, Wall Street firms go out, they talk to management, they find out what's going on as far as their product sales and whether or not they're likely to meet targets. And then they come back and they actually invest money for clients. So they're going to take that knowledge and decide what to invest in, what not. So it is important to see how these stocks perform relative to their peers and to the S&P 500 in general. And so don't be shocked when you see a company that's been underperforming on a relative basis all of a sudden come out with bad news. That's exactly what I would expect. One other example of this is with ConAgra Brands, which did the same thing. They missed on the top line, missed on the bottom line, and they guided the next quarter lower. And when you take a look at the chart, you can see that the stock topped about 3, maybe 4 months ago relative to its peers, and it had been moving lower. And then, of course, with the gap down yesterday, really took a dive. But this is a stock that was not one of the leaders heading into its earnings report and disappointed, and shouldn't be shocking to those who follow technical analysis. I know you've got a ton to go over there, Erin, so I'm going to turn it back to you. I'm going to turn it.
All right. Yes, I got it. I'm sorry, we're having the mute button issue here. Okay, so let's go ahead. I'm going to share my screen. We do have quite a few upgrades and downgrades. Actually, quite a few more downgrades than anything else. So let's go ahead and look at our list so I can show you quickly. All right, so 3 upgrades right here and then 5 downgrades. So I'm going to start the downgrades. I'm going to move through pretty quickly because we do have quite a few here. All right, so CAI International. This one was downgraded by Wells Fargo from an outperform to a market perform. Clearly, investors unhappy about this. What I noted is we filled this gap back here from late July. I would expect to see prices continue lower at this point. Of course, you have a few areas of kind of intermediate support, you know, in between the very lowest area of support. Right now, though, that March low looks like a certain possibility here. At best, I would look here at that $21 level as a possible area of support, but you know, look at PMOs on its way down on a sell signal. The only positive here I would say is if you look here at the rising bottoms on the OBV, I think that's somewhat positive, but really with this big decline of over 10%, you might be able to get it on, you know, with this weakness in that $21 range, maybe set your stop to about 20, but that's for bottom fishers who don't mind the risk. IPGP, IPG Photonics. This was downgraded from a buy to a neutral on Longbow. Doesn't seem to have really affected their price much today. It is down a little bit over 1%, but you can see we're sitting right about on that support level. I'm going to pull up the weekly chart just briefly so we can get an idea. But look at this. It does have the hallmarks of a reverse flag, which of course would indicate that we could see a drop all the way down, goodness, back to this area of support from 2015 and 2016, which is all the way down to about 105. Now, I don't know if we're going to actually see a drop to that level, but it's certainly doable at this point. Notice the PMO, though, it's getting really sold here on the weekly chart, but you know, looking at what's the normal range is likely here, it's probably 10 to minus 10, and so I think you could see it get a little bit more oversold and accommodate a little bit more downside. MedEquities Realty Trust. Cantor Fitzgerald downgraded this from an overweight to a neutral. And as you can see, investors also not liking it. But I think the important thing to note on this chart is we are also sitting on support right here. And that's right where our intraday low is sitting. PMO is it had started to decelerate. It is oversold, and we are at an important area of support. Let's go take a quick peek at the weekly chart on this one as well. There we go. All right. And as you can see, we still could move a bit lower on this at this moment in time, but this is a pretty tight area of support. So I think we could see it stop at this area, but then again, look at the PMO. It's not looking so hot. All right, Phillips 66 also downgraded today from equal weight to underweight. It's currently only down, well, it's almost unchanged here. And we can see it has hit some very important support here back from those June, July lows. This might be an opportunity to get in on some weakness, but the energy sector, you know, there are some issues going on there. So something to consider. But notice the PMO is trying to decelerate, even though we've had this really long tail and this test of support. So I think there is possible opportunity here. You certainly have better EMA setup, although we do have that 20-50-day EMA negative crossover, which would give the decision point models a neutral signal. C-SPAN, here we go. We had a downgrade also on SSW C-SPAN, and we are looking at Wells Fargo, moving it from a market perform to an underperform. So a lot of these aren't moving to neutral today. They're moving downward. They're looking at underweights and underperforms right now. You've got support. I think there's still some support further down here at that gap. I would be watching to see that gap fill. I think you could make a case for a head and shoulders here off of this rally to the upside. I see downside here, and it looks like Wells Fargo does too. All right, let's look at some upgrades. Blue Cora. JP Morgan moved this from a neutral to overweight, and investors seem to really like that. Let's go ahead and pull this up and see that breakout a little more closely. Make that a bit thinner. Really nice breakout, currently trading above that overhead resistance. This is a level that's reaching a high for the year. So it's looking pretty good here. You had the PMO already starting to rise back here in mid-September, so something good was lining up. You can also see how it had been moving really gently up to the upside, and now it's in positive territory. So looking pretty good here for Blue Cora. Might want to look for a pullback, but at the same time, this area that was overhead resistance, I think, could form some pretty good support ultimately. NVIDIA, as we were talking about, the target was raised. Let's look at that chart more closely. And really, when I look at it from my analysis style, I like it. I look at the PMO is just now turning up on this nice move to the upside, but they're saying that, you know, NVIDIA has a lot of potential in the AI space. And so that was one of the reasons cited, I think, that I read on this target being raised. I thought that was very interesting, but it is up 4.5%. You may want to wait for a pullback. I mean, we've hit really short-term overhead resistance at that mid-September level. And then finally, let's go ahead and look at our final Scanacorp. And this one has had an upgrade by UBS from underweight to neutral. And as you can see, we have a PMO buy signal that's just hit. You've got all those EMAs starting to move the right direction to the upside. We do have a little bit of overhead resistance here in the short term at that August top, but I think you could look for a move even all the way up to that $43 level. Maybe set a stop on this at that 20-day EMA down here for a more intermediate term potential here and investment. So I think you could look for some upside up to that $43 level. I think that's not out of the question here. And of course, if you drew a declining tops trend line, it's also confirming this really nice breakout from that declining trend. That's all I have for upgrades and downgrades. So why don't we go ahead and Mary Ellen, I know you're hanging out there in the background. Let's bring you to the foreground.
Sounds good. Let me go ahead and get on board with you guys, and we can go ahead and get started. As I said, lots going on. So we're going to be talking about today what's hot, what's not, and I'm going to throw in how about what's new. And one of the bigger news items as it relates to the broader markets is the reclassification, the reshuffling of a number of mega growth stocks into the new communication services sector. XLC is the ticker. StockCharts is all over it. We'll go ahead and take a look at the chart for that ETF in a minute. But what I wanted to do is start by showing you the top 10 holdings. We're looking at Yahoo here. This is the top 10 holdings for this new classification, communication services sector. You can see Facebook top holding there, over 18%, Google, Comcast, Disney, and so on. So these are your big names in this group. And what you can see here is huge number of growth stock, mega growth stocks in here. So 61%, or the majority of the stocks in this XLC, are now comprised of these growth stocks. Prior they were 100% value stocks. So there's been a big shift here within these stocks. And what it's done and what it will do is allow the other sectors that these larger components were a part of, i.e. technology sector, as well as consumer discretionary with Netflix, it's going to allow those other ETFs to be more pure plays, if you will. But more importantly, for what we're looking at this week and maybe going a little bit more forward, is the fact that the new sector is going to generate about $30 billion in market activity. This is according to State Street, but it's as active investors as well as passive ETFs. They need to readjust their positions to reflect these new weightings. So we are seeing activity in a number of these underlying stocks, but I will argue that there are other very sound fundamental reasons why a number of these classified larger stocks in here are looking quite attractive. So let's go ahead over to StockCharts.com. And as mentioned, I'll go ahead and we'll take a quick look at that XLC, this newly defined sector. And you can see that it was non-existent, but now more recently it is being populated and brought live, and it is trending positively. I think you'll see a lot more in the way of upward momentum as we start to review some of the underlying stocks in this sector. So let's take a look at Netflix. This is number 10 as far as the weightings on the top 10 for this new sector. But take a look at how this stock, it had been underperforming. The company came out with earnings. The earnings were quite superior back here. However, this is that gap down. However, the company had announced a reduced number of subscribers. So with these types of live streaming type of companies with media live streaming, subscriber base is going to be more critical than earnings. So what we are seeing now is a recovery from this downtrend. So I like to see the stock break back up above its key simple moving average. This green line is the 10-day, the red is the 50-day, and then this broader blue line is the 200-day. But again, here more currently, we can see that the stock is coming up against what normally would be resistance. The RSI is trending positively, and your MACD is trending positively as well. And the reason here is because recent analyst notations as well as comments from management are pointing toward an increase in that subscriber base. And in particular, the company does have their eyes on India. They see that as a huge growth area. And the company is also making other adjustments. They are cutting back as far as where viewership is weak, they are discontinuing programming and adding to where they see strength. So they are starting to take action as far as potentially reducing cost where it's not effective. So that's Netflix. Let's go ahead and take a look at another big name in this new sector, and we can take a look at Activision, ATVI. This was one of the top 10 players. This is Activision Blizzard. They do gaming software, which has really been reinvigorated. It's a big area within consumer discretionary, but now in this new sector. And let's take a look. We can see that the stock is very, very much in an uptrend. It's now trending using this 10-day simple moving average as support. It is a bit extended. We can see that the RSI is very clearly positive, as is the MACD. This is another company. It's up almost 4% on the week. Analysts are upgrading the stock because they are really excited going into the holiday season. This company has, Activision has a number of very popular software gaming games, if you will, Call of Duty for any of you that follow it, Candy Crush. So they have a lot of popular ones, but more importantly, they have new additions that are going to be released into the holiday season. So that has analysts excited and investors entering into the stock. Let's take a look at Disney. This is another top 10 component of this new sector, communication services. And Disney, this is another stock that you can see quite clearly. It is in a very bullish uptrend, and the stock has also introduced new information relating to, they're going to be offering direct-to-consumer streaming. And this is very, very revolutionary for Disney, very new, but it's expected to be a big source of revenue for the company. And they're also going to be offering flexible pricing with that new model. The stock's up over 6% for the week, but you can see that it is emerging out of this base that's taking us back about 3 months. So very bullish action here. And it's occurring on strength, which is also viewed as quite positive. So those are some of the highlights as far as that newer sector. Let's go ahead and drill down to what's hot within industry groupings. And one area that we can take a look at that we touched on last week, but it's continuing to show quite a bit of strength, and that's the energy sector. XLE is what we're looking at here. And there are several dynamics that are driving some of these energy stocks, particularly the oil production space and the drillers. And one of the reasons is because last weekend OPEC decided to keep oil production levels where they are. And of course, that's going to help with the pricing of oil. And then also analysts upped their outlook on oil prices as well, because of the fact that the U.S. has sanctions against Iran that they will be imposing. There's an anticipation that that is also going to reduce production levels significantly. So we're now seeing oil pricing at a 4-year high, and this is pushing a number of these energy-related stocks higher. Not all stocks in this area are positive and are participating, however. So I'm going to go ahead and highlight a couple of the winning stocks, names that you can put on your radar screen as they are not only behaving in a constructive fashion. Oh my goodness, this one's up 4% today, but it is a stock that emerged out of a very long-term base, and it did so on big volume. So it's very constructive technically. The RSI and the MACD are positive, but this is a company that also has triple-digit growth prospects, and analysts like the stock. We'll take a look at another name that is a large energy-related stock. This is EOG Resources, and the stock is poised to break out of, again, another longer-term base. Your RSI is positive, as is the MACD, and this is another company that has huge growth prospects. They are in the exploration and production area, so they will benefit surely from higher oil prices. But I did want to point out a couple of names that are not outperforming. So you can clearly see the difference when you are on the prowl, if you will, for stocks that could be benefiting from these higher oil prices. This is Schlumberger, SLB. The company came out with disappointing earnings, and analysts, the street did not like it. It continues to underperform. We can see where it is trying here to reverse this downtrend, but it is not with any kind of positive action. It's still below this downward trending 50-day simple moving average. Your RSI and your MACD are still negative, and one other negative stock that is well known, a bigger one. This is Chevron, CVX. Now, the stock is starting to potentially reverse this downtrend. But what I did want to point out to you is the stock really is not participating as heartily as EOG and MRO. And that is a signal that you are looking at a laggard stock. While there are those of you that may think you're getting into the stock earlier and it's not as pronounced in its recent moves, I would argue that this current action is telling you that this stock is a laggard and that it is not going to be poised to really outperform in any significant way. And Tom, I think I know you've been looking at the energy grouping for quite some time here, and you might have some comments to add.
Yeah, I was just going to show everyone, of course, 4 of the areas that I like to follow on the within the XLE, within energy. You can see them here on this RRG. It's the DJUSOI, which is your Oil Equipment Services Index, the OL, which is Integrated Oil and Gas, OS, which is Exploration and Production, and then PL, which is Pipelines. And I just thought what I would do is compare these industry groups within the XLE. So this is the chart of what's been going on with the XLE. It's been all over the place. But let's take a look at which groups have been leading. I think pay particular attention to the DJUSOS, which is the Exploration and Production Group. And you had mentioned, I think, EOG, which is in this group. Mm-hmm. But you can kind of see it. It's just over here staying on the right side of this chart, while the other groups kind of lag. So to me, yeah, I mean, pipelines definitely they were strong for a while. They're starting to weaken now. But these are the 2 groups that I would probably tend to focus on, but especially the exploration and production stocks, the DJUSOS. And I just wanted to mention one other stock. I did like the EOG stock that you spoke of. And one of them that I think is really beginning to strengthen again is Whiting Petroleum. And you can see the huge move the stock made back May, June. Seems like maybe an extended cup that's forming, heading toward the right side. Maybe we get this breakout, and I'll show you the group itself. This is going back the last year, but the DJUSOS has had the beautiful move up, sideways consolidation, and it's on the verge of a breakout. And if we get that breakout, I think you want to be looking for some of the leaders in the space. And when you come down and you look at here's the group, the DJUSOS, and then here is Whiting relative to the DJUSOS. So I think we've got a pretty good stock here. Went through a period of consolidation. It's just now starting to turn up. It's at about a 2.5-month high now on a relative basis to its group, and it's turning higher against the S&P, and the overall group is beginning to strengthen again relative to the S&P. So I think if we get that breakout, I think you've nailed this one on the head, Mary Ellen. I think that the production stocks do look good, and I would throw Whiting in there as one that's strengthening as well.
Yeah, super. I agree. Just looking at that WLL, analysts are revising their estimates higher going into 2019. So that's certainly another bullish consideration. And I really liked how you did that comparative, because you do want to look at the relative outperformers when you see a group being introduced, a rotation into a group, because those outperformers will continue to, historically, this is history, tells us those outperformers will continue to outperform as that group remains in favor. So that WLL does look very attractive. So let's go ahead. I did want to move on. There are a couple of other areas that are hot. and in case I didn't mention it, this is for this week. We're looking at stocks Monday through Friday. We want to get in front of those moves, those areas that are showing more dynamics, certainly with an eye toward continued dynamics in that given area. So one area that, let's go ahead, we are looking at the sector summary. I'm going to go ahead and pull up 1 week. So this is taking into account the 5 most recent trading days. And we can take a look here at the consumer cyclicals. This is going to be your retail related stocks and leisure type stocks. Now, if you look at the grouping, it's up 0.44, certainly not as dynamic as some of these others. However, there are pockets of strength within the consumer cyclicals that are having a very nice week. We're seeing a move back into some of the recently strong areas. So here again, this is a 1 week view. We're looking at the performance here. You can see apparel retailers is up 2% for the week, clothing and accessories. I'm pointing that out because these are areas that have led consumer cyclicals into the beginning of the year, and they have more recently taken a bit of a pause, but we are seeing a move back into some of these stocks. So from here, you can go ahead and click on to that industry group name. And the very first stock that comes up here is Canada Goose. I just want to spend a few minutes taking a look at this stock because there are dynamics that are driving this stock higher, and analysts are anticipating huge growth over the next 5 years. So Canada Goose is a company that is based out of Canada, and they produce, one of their primary products is a very, very high-end down jacket. And one might think, well, how could that carry a company? Their down jackets are almost a symbol of, oh my goodness, I can't think of the right wording, but I will tell you, over in Asia, there are individuals that will wear these down jackets when it's 90 degrees and humid. So it does have that cachet. And so if we're looking at here, this is the company, they reported earnings in June, gapped up. And then their most recent earnings report was not that dynamic. But let's take a look here at this pop up. And I'll tell you the reason is because an analyst, Wall Street firm, came out and revised their estimates quite a bit higher for this company. And the reason is because the Canada Goose is expanding beyond Canada. They're coming into the US. They have a big footprint in Europe, and I talked about Asia. But the other dynamic is they are introducing more apparel so that they can become more than just a seasonal cold weather product company. They are introducing products that will expand them so that they will be 3 seasons. And just to give you a feel for the analyst upgrade, currently the company just reported their year-end quarterly revenues at $500 million, and analysts are expecting that growth to be $1.5 billion over the next 5 years as the company continues to grow. So that's certainly one of the stronger names this week within the apparel retailers. But there are other areas and other stocks that I wanted to point out to you because, again, a lot of these stocks have pulled back. They've sat out the recent rally in the markets, but they do now appear poised to wake up, if you will, and potentially reverse their recent downtrends. This first company is Burlington Stores, BURL. This is a discount retailer. The company is opening new stores at a very fast, rapid pace, hence the eye toward growth with this stock. But let's take a look at it technically, and we can see that the company for this past 2.5 weeks, we're looking at a daily chart. So yeah, the last 2.5 weeks, the company has pulled back to the point where it did get below that 50-day simple moving average. But more recently, the stock has broken back up above these key simple moving averages in a bullish move, and it's done so on volume. So that's really constructive. We're not quite out of the woods yet in the sense that the RSI is trending positively, but we're not really in truly positive territory. We have not had that positive MACD black line up through the red quite yet, but I would put this on your radar screen. It has sound fundamentals, and it very well could be reversing that near-term downtrend. Let's take a look at another in the consumer retail discounting space. This is TJX Company. This is another stock. It gapped up quite high on earnings going back into August. You can see the stock subsequently did have a move beyond that as analysts continue to revise estimates higher. This company is in a real sweet spot as far as products. They provide home improvement as well as apparel, two hot areas within consumer discretionary. But we can see the stock did pull back after this big move. It has sat out the recent rally, but more recently it does appear to be coming back to life. If we see a breakout to a new high on big volume, I would expect TJX to continue its upward momentum. Ross is another apparel retailer, discounter. ROST is the ticker symbol. Very similar dynamic where it really has been in a go nowhere type of environment. It's pulled back, but more recently it appears poised to continue its more recent uptrend. And one other area that I did want to point out to you in, let's see if we can capture it by going back to the sector area within StockCharts.com. We're going to go to this sector summary, take a look at these cyclicals, and then what we can do is take a look at the 1 week move to get a little more feel, a little more in the way of dynamics. And I'm not sure if I'm seeing it here, but there is another area within the consumer cyclical space that has picked up, and that is the travel hotel related. We'll just take a look at a couple of stocks and then we can move on. But this is Hyatt, and analysts are revising estimates higher for this stock, and it's another company indicative of having sat out the markets, and really it has sat since May. We've not seen any type of outperformance. The stock is reversing that downtrend. It's up over these key moving averages. Your RSI is positive. Your MACD is having a positive crossover. So this would certainly be a name to put on your radar screen. Marriott, not as dynamic. We still need to see a break up above that 200-day, but that was another area in consumer discretionary. And I believe, Tom, you had a couple of other areas there as well that we can take a look at.
Yeah, I'm going to do the same thing, essentially looking at some of those industry groups within the consumer discretionary area. So I've got, you mentioned clothing and accessories, that's the DJUSCF, and then footwear, DJUSFT, and then the apparel retailers that you talked a lot about there, the DJUSRA. And I'm comparing it to the benchmark S&P 500. And I want you to, this was 1 year ago. And so you can see that the footwear was definitely lagging. And I wanted to just show everyone kind of what that looks like on a price relative chart. So here I've got footwear relative to the S&P 500. And 1 year ago, back in September, you can see that we were declining. So footwear was what was massively underperforming the S&P 500 a year ago. And so that's when you're looking at RRG, that's what this is telling you. It's over here in the lagging. But starting in October, look at this outperformance in footwear. And the way that this shows, watch the red line here or the footwear line as we go through the chart here. Look at this exploding back at the end of 2017. I'm stopping right here so you can see down here. This is the 5 weeks ending. Whoops. Okay, let's move back again. There we go. Okay, it's the 5 weeks ending December 15th of 2017. But look at that long tail. That's one of the things Julius talks about with us when we get these long tails. It's telling us that this thing is rapidly moving. So this was at the end of 2017, but watch the party that these three industry groups have on the right side of this RRG chart throughout the entire 2018. I mean, every time we get a little bit of weakness, we turn back up into the leading area. And so what we've seen over these past 5 weeks is weakening, but we're still on the right-hand side of the chart. And again, if I just show that one more time, it's very normal. Let's just highlight that apparel retailers right here. Watch this turn in the middle of the year, how it just turns right back and goes back into leading and then weakens. And now it's already starting to turn back up. And that's what I think you were alluding to, Mary Ellen, that we're starting to see that money rotate back into apparel retailers. And I think you really can visualize that with these RRG charts. And again, this isn't saying that the apparel retailers necessarily is going up. What it's saying is that it's beginning to improve relative to the S&P 500. So we would have to go in and actually pull up the chart on the DJUSRA to see whether, in fact, it is going higher. And you can see it is trying to make that breakout over that early September high. And this is one of those areas of the market. Now, I pulled up ROST in this space just to get everybody an idea of what you're looking at here. But this is a company that's been going up for quite some time. The group is going up for the most part, especially these last 4 months. You can see that Ross Stores is outperforming its peers. It's been outperforming the S&P 500 for a long time. And here the group has been outperforming the S&P. So when you get a chart lined up like this, wherever all of these charts are moving from the left side of the chart to the right side, I think that's really bullish.
Super. Yeah, that's certainly a picture is worth 1,000 words. That really does tell quite the story. And in fact, that is certainly in my experience how these retailers tend to perform. They're the last to report during earnings season. They oftentimes, more recently over the last 3 quarters, will gap up and then sit out the broader markets and potentially eventually resume their uptrends, which it appears we're experiencing here now. So yeah, now let me, before I run out of time, I do have to cover just a couple of areas that are not hot, and make you certainly aware of areas that are underperforming the broader markets with an eye toward keeping you out of these spaces. One of the worst performing groups this week is the financials XLF. And you can see that the overall group is really under quite a bit of pressure. So this is one of the largest components of the financial space or the financial sector is banking stocks. So let's just take a look. This is the regional banking ETF KRE. You can see the severe underperformance that this group has been experiencing. And I'm going to review very briefly some of the dynamics as far as why we could very well be seeing this underperformance here. And one of the reasons I'm taking you to, it's called gurufocus.com. And with this chart and what we're looking at here is what's called the U.S. Treasury yield curve. And quite simply, it's telling you the spread or the difference between the 1 year, which is the 1 year Treasury is at 2.5%, and the 10-year is at 2.9. This is as of 2 days ago, but this is something that's updated regularly. And the reason that that spread is important is because with financial stocks, these banks, they turn a profit by lending using this long-term 10-year, and the banks borrow at the shorter term interest rate. So this spread is going to be very, very critical to their bottom line, to their profit margins. And let me go ahead and show you here. This is a graphic display of that 10 to 1 year spread. And what you can see here is just how narrow that spread is continuing to get. So as we get closer to this net neutral, that 0, that is going to be no profit at all. So we've seen a continued decline going into 2018. This is an active, you can see that right now the spread is at about 0.41. So as this spread continues to deteriorate, it is going to impact these banking stocks negatively. Another view here is looking at the actual Treasury yield curve, and it's the same phenomenon where it's looking at the shorter term Treasury yield and plotting it versus the longer term. So what we can see is, depending on the color, let's take a look at September 2016 as of the end, the 1 year period there. You can see the real nice slope in that Treasury yield. Likewise for last year, 2017. But notice the blue yield curve is the current. You can see a really significant clear-cut flattening of that yield curve. So this is going to be something that is negatively impacting these banks. And a number of banks are, in fact, pretty much across the board, they're all getting hit. I could not come across one that looked positive. This is Bank of America, a lot of the money center banks, and they're all suffering. And these companies are all due to report. The big money centers are going to be reporting earnings mid-October, so in about 2 weeks. So that may help turn these stocks around. It's unclear, certainly at this point. And one other area that's not hot are consumer staples, but I am out of time. But this is impacting a number of stocks: Kellogg, Hormel, Hershey. They're all being downgraded this week because there's fear that their lower pricing, as well as the need to put in costs to expand their product lines, is going to cause these stocks to not come out with good revenues. So I will go ahead and leave it at that, unless
Yep, there were no questions in the room, so you were obviously very clear.
Okay, good.
Thanks so much for bringing all of that in. I think it's great addition to have you coming in on Fridays to give us this what's hot and what's not.
Super.
Very much enjoyed that.
Great. Have a wonderful weekend.
Absolutely. We're not too far from each other, and it is supposed to be a beautiful one.
Well, I'll see you at the beach.
There you go.
Thanks very much.
Take care.
Take care.
All right, so here are the stocks that Mary Ellen went over, what's hot and what's not. I'll have this up in the Market Watchers Live recap today if you want to take a peek at those charts yourself. So, all right, let's get started on our 10 and 10. Hopefully you're ready there, Tom.
I'm ready.
Yep, let me go show you all the, I'll show you the RRG here. Let's make it bigger. All right, so this is the daily version. So if it looks different than what maybe you did for your particular stock, that might be why. I'll be looking for stocks that are moving in that northeast direction. I don't put any stocks in the 10 and 10 that have been requested in the past week. And the most popular in the chat room will be the second one. But our first one, well, let's first look at these sector requests. Technology, clearly what everybody wants to look at. So we'll definitely pick some of those to look at. But our first one will be SeaWorld.
All right, let's take a look at SeaWorld, SEAS, and a couple things I noticed. First of all, we're in a beautiful uptrend. Clearly, this is a stock that has been outperforming. Even when its group, its peers, were moving lower throughout the first half of 2018, you can see that the stock continued to power ahead. And as we've moved higher, the stock has continued really to outperform even a really strong performing group. So I just wanted to highlight these blue arrows showing you that at least currently we have all 5 of these charts now pointing from the left side to the right side and gaining ground, which is a good thing. So I like the stock. Now, do I like it right at this price? No, I think maybe we could be sideways consolidating after a huge move up, very similar to what we did back in June and July. We had the huge move up, and then in July, we simply consolidated. The way that this looks right now looks kind of similar to the way it looked at the beginning of July. We had a big move up, pulled back, kind of right off this 20-day moving average or close, and then bounced and went right up to the resistance area and struggled, couldn't get through. So from a short-term trading perspective, I would be using the short-term strength as an opportunity to exit. And then if we pull back down close to the price support area around 30 bucks, I would re-enter. Now, from a longer-term perspective, what I'm most interested in is just sticking with the stock because it is an outperformer. So it comes down to your trading style. But either way, I do like SEAS. It's just a question of when to buy. And on a short-term basis, I'd see if I get a little bit lower.
All right. Well, we have a tie in the chat room for most popular. So being the benevolent person that I am, I will include them both. So let's start with Alphabet. See if you know that symbol.
Yeah, I've run across that one from time to time. I still can't call it Alphabet, though, so I'm going to talk about Google.
I was trying to stump you there.
Yeah, I like some of the volume coming in here and moving back through the 20-day. That's a good thing. We've got to get back through resistance, though. Google did lose some key price support. And in order to really begin to improve, I think technically, we need to get back through. This was a gap support area. We gapped up with earnings back in July. came down. You can see successful tests there, bounced back up twice, and then we lost this area of support, and you can see the volume pick up on the selling. Now, the overall trend is still higher. I think we got a series of higher highs and higher lows. So I think Google is fine. But in the near term, now that we've gotten through the 20-day, can we get back through that price resistance? That's what I'll be watching.
Okay. And the other popular one was PSHC, the small cap healthcare ETF.
Yeah, I love the small cap, or I love healthcare, and I really like the healthcare small cap side of things. But the problem is, and I talked about this earlier, the dollar has been weak over the past month or so, and that's leading to some underperformance here in the near term. I think the dollar is going to rally, and so I think this is a good time to get in. I think you've got pretty good price support on that most recent breakout, which is right at about that level, 137.5. We almost went all the way back down there after getting up to 145, but I think we'll move back up and not only test that earlier high, but I'd be looking for a breakout.
Okay, let's see. The next one I have for you is Coremark Holding, CORE.
Okay, some consolidation. We did have a negative divergence that has me a little bit worried here because the volume kind of dried up on that negative divergence as well. But this is what I'm talking about here. You've got your higher prices, then you've got your lower PPO. Right now, we're just kind of consolidating near the 20-day moving average. But on this breakout right in here, you can look at the volume here relative to the volume we had seen earlier in August. So the volume was declining as we were making a breakout. That also makes me think short term we could be in for some consolidation. But what I would expect is that the trading range between about 37.5 and down here to the recent low around 32, I think this is going to hold. So I'd be a buyer closer to that 50-day moving average.
Okay, the next one I have for you is in that healthcare space, medical equipment, Boston Scientific, BSX.
Yeah, it's another great performer in a great group. Not really a whole lot to say here. I mean, we're trending higher. Let me get the directional line. I mean, when you look at a chart like this and it just keeps going up, it's kind of hard to be disappointed about too much. We did clear. I'm going to say that there's pretty good gap support right between about 36.5 and 37. You can see this gap came on some increasing volume. So I think BSX looks pretty good. Anything back down near that 37 level would be a buy for me.
All righty. Let's see. Vale, VALE. It is a steel industry.
Okay. I think I mentioned this one the other day when I was looking at the steel, talking about the seasonality.
Mm-hmm.
I don't remember if it was one of the better ones. I have to go back and look. But technically, we are getting a nice breakout here. So let me annotate. And that was the high back in May. And we cleared that. Look at the volume that's been coming in. Now, sometimes you do fail to hold these breakout levels. But what I would do, I think the stock's getting a lot of interest. Volume is good. So I think a pullback, if we do fail to hold this area right in here, I think we could drop to the 20-day moving average. But I would be a buyer right here on the 20-day. So I think this is a good looking stock and in a space that tends to do well in the fourth quarter. So overall, I would be a buyer here.
Okay. Let's see. The next one will be DRE, Duke Realty.
Okay, just consolidating for now. I don't see anything great. I don't see a great entry point. I don't really see, you're not at a sell point, kind of in the middle of this range. I think for the past several months, the support level, and we could maybe put one more support in here. It looks like this 27.25, 27.5 area is worth watching to the downside. That's where buyers have stepped in previously. I'd expect them to step in again. To the upside, you can see that we've had a double top up near 29.25. So this is the range we're in. And with the stock trading currently at 28, I don't see a trade in the near term. But if we pull back and take another dip into this 27.25, 27.5 area, then I think your reward to risk lines up.
All right, here's a software company for you. It's at some really interesting support. I'm kind of liking this chart a lot. SAP.
Okay, SAP. Yeah, I like this one too. I like that breakout on the big volume you see here. We're going back down to test the area of the breakout and getting closer to that 20-day moving average. So, yeah, this is a stock that would be pretty easy to get behind. You've got a really nice PPO building here to the upside, and now that we're pulling back, I think gap support and the 20-day moving average. Actually, gap support isn't that great on this stock. You can see the stock gaps up all the time. So I wouldn't worry too much about that, but you can see clearly that the prior price highs were right at about 122, and we went through this basing period, which I find to be very bullish when you break out, especially when you break out on big volume. So I like the stock down here around 120, 175 to 122.
All right. Next in electronic equipment, Turtle Beach Corp. I'd like to see it break out above that declining tops trend line, but I think other than that, it's looking not too bad.
Yeah, this is here, HEAR.
HEAR, yes.
Okay. I'm going to pull this one up on that relative chart. Yeah, because I knew the group was going higher. Now, first of all, this company wildly outperformed. You can see that its peers was simply going sideways, even down, while the stock went crazy with massive volume. I think it's just trying to find itself here. I don't know if the most recent low is going to hold or not, but I would be watching the 20-day moving average. I think if you move back above the 20-day, I think that would be really bullish. I would also watch this relative strength line, which has been declining for the past 6 or 7 weeks. I don't find this to be necessarily negative because it went up so much in the prior 3 months. So I think just like a stock that goes up, you got to give it some time to kind of pull back and regroup. And I think on a relative basis, we see the same things from time to time. So if we get a relative breakout here of this trend line going down and we get a move back through the 20-day moving average, that is what I'd be looking for here on the stock for it to regain that strength that we saw before. So I think what I would do annotating here is just a little reminder that we keep failing at the 20-day moving average all along here, and we're testing it again today. If we could break back up above it and especially get some volume coming in, I think the stock could make another run for its earlier high. That would be a pretty exciting move to the upside. But the problem is trading it underneath the 20-day when it's underperforming is that this could continue for a bit longer. And so I'd wait on entry. I would just be watching it for now.
Okay. Let's see. The last one is in the computer hardware industry, 3D Systems, DDD. I think you're going to like this one. I'm not a fan, but I think you might like it.
Yeah, I do like it. I'm not sure I like the price right now, but I definitely like it. If this thing got to 18, I would be very excited about it. Let me go ahead and annotate. Okay, so first of all, you've got computer hardware stock, as you mentioned. Computer hardware has been a great place to be in the market. It continues to move higher. You can see that this stock broke out on a relative basis to its peers. The stock broke out relative to the S&P, and its peers are trending higher relative to the S&P. So the first thing you have to know is you're in a good space, and you've got a good stock within that space. But even better yet for me is you've got 2 key areas of support. One being all the way down around 16 and change. I don't know if we go back down there anytime soon, but after the big move up on heavy volume here over these 3 days, the pullback came back to 18. Then we went to a new high. We pulled back to 18 again, actually 2 more times. And now we're just kind of going sideways. I think we're in a trading range between 18 and 22. So the closer I can get this to 18, the better I like it. If it fails to hold 18, I'd probably get out and then see if I could get in maybe around 16 and a quarter. But I do like this stock. You're right about that.
I had a feeling. All right. Well, that completes the 10 and 10. And here are the symbols that we did go over. I will have those up in the Market Watchers live chart list. All you have to do is go to the blogs page on StockCharts.com and click on the Market Watchers live blog, and you'll find the link right there at the top. You can then copy these charts and chart styles and enjoy them for yourself. Okay, time for our final market update. Let's go ahead and get started with that. There it is. Okay, so here we go. You know, the market's open lower. It looks like a little bit of a confusing day as far as trading. Open lower, moved higher, but it looks like we are starting to slide back down. We still are looking at positive numbers, though, for the Dow, the S&P 500, and the NASDAQ, but just barely. The OEX has already moved back into negative territory. I suspect we're going to see negative territory for the S&P and NASDAQ, possibly the Dow. Although I have to say the 400, S&P 400 and Russell 2000 are looking pretty healthy. While they did, actually the Russell 2000 did not open lower, it doesn't appear, but the mid caps did. Still starting to consolidate now, but not pulling back like we're seeing in the other large cap indexes. We could see that Canadian markets are lower, gap down and continuing lower. TNX is down somewhat. That yield is down slightly, reading 3.044%. UUP, big gap up on the open, but has pulled back toward yesterday's close. Currently, UUP is only up 4 cents at 25.24. Gold is higher on the day. Looks like it's forming an intraday flag for us right there. And it's closed the gap. It looks like, well, not quite closed that gap from the open on, it looks like Wednesday. So we should see gold rising higher. I'm still feeling pretty bullish on gold, but it is being rather stubborn about breaking out. And now it's trying to make up the losses that it had yesterday. So we'll have to see what happens with that. But currently up 78 cents for GLD at 112.83. TLT is mostly unchanged today. USO is riding nicely higher. We've got intraday highs currently being made. Looks like we pulled back slightly off of the intraday high, but currently trading at 15.54 for USO. So good day for oil. And that's all I have for the final market update. Tom, I'm going to hand it back to you.
Okay. Yeah, just one final thought about that PSCH, which is that small cap healthcare. I just wanted to kind of illustrate this point based on what the dollar's been doing. You can see this is a 6-month chart, and we've got the dollar up here on top. Then we have the PSCH, which is the small cap healthcare ETF. Then you have the XLV, which is a much bigger version, size companies anyway, within healthcare. And then finally here at the bottom is the PSCH relative to the XLV. And what we've seen in September is the PSCH small cap healthcare going down, while overall the larger cap XLV has been moving higher. And the one thing that's changed is that the dollar had topped back in August and reached a new low just about a week ago. And so that was a problem for the PSCH relative to its larger cap stocks within healthcare, because a weaker dollar favors large cap companies, because those are the companies that have their operations, or have some of their operations anyway, overseas. So they get a more positive earnings outlook and translation based on that falling dollar. But what we're seeing now is the dollar turn back up again. And with that, you can see that the PSCH is starting to turn higher, and we're just starting to hook higher in this relative strength as well. So the dollar does play a big role, not necessarily in whether the overall market goes up or down, but it does play a role in which areas of the market we tend to see rotation to and from. So I just wanted to illustrate that point, and be on the lookout for the dollar, because if it does go back to those August highs, I think within healthcare, and I'm a fan of healthcare, but within that group, I would be putting more of my money into those smaller cap stocks.
All right, good to know. Let's go ahead and move into our final segment, the Decision Point Sentiment Update. And of course, it's always interesting information, but today I hope you're going to enjoy what I have to show you here. So let's go ahead and get started. I'm going to talk to you about the 10-day moving average of the put-call ratio. We'll look at the American Association of Individual Investors. I also follow the National Association of Active investment managers and what their exposure is to the market currently. We have the decision point right-ex ratio that we came up with to show asset and cash movement. And then we have breadth and VIX that I'd like to show you charts for the ultra short term, help you to expect what to expect going into next week. So let's go ahead and get started. Here is the put-call ratio. And before I start getting into the discussion of the chart as it is, I want to reiterate a few things. Number one, that sentiment is a contrarian indicator, meaning that if everyone is bullish, that is actually bearish for the market because you've got too many buyers, and that's when you're going to see the sellers come in, and you're going to get that market reversal. So we look for extremes in bullish behavior and sentiment, and we look for extremes in the bearish side of things because that's where we can look for reversals as far as price action goes. So I also, on some of these, like with the put call ratio, I have inverted the scale because I like to think of the top of my indicator window as overbought and the bottom of my indicator window as oversold. And typically when you get an oversold reading, you start to expect a movement to the upside. Well, in the case of the put call ratio, the bigger the number gets on the top, the bigger the ratio gets. Well, the puts, the bearish reading is on top. And so the larger that gets, the larger, of course, the reading will be. And so if everybody is very bearish, that should be on the bottom of the pane, right? It should be lower because that's oversold territory as far as sentiment is concerned. So that's why it's inverted, and hopefully that helps you understand how to read these if I'm not here to point it out. So you can get these charts, some of them anyway, in the Decision Point chart gallery. And there's a link to that right off of the member homepage in that right-hand box where you can get to all of the sector summaries, market summaries, and tools. All right, so what is this chart actually telling us right now? Well, you can tell that it did move itself up into that oversold territory. And you know what? I don't think I have my arrows showing right now. I could be wrong, but I'm pretty sure I don't. So let me get back here. All right, that should help. All right, so you can see, whoops, well, let's try and go back here. Okay, you can see that we had overbought readings here somewhat. It wasn't at the top of the range like we have seen previously, but it was still a top, and it has turned down and is moving lower, and that's for both a CBOE and equity. And when you start seeing those declines, that means, well, you get the top because everybody has gotten very bullish. And when it starts to fall, that indicates that they're starting to think about getting bearish. They're just not as bullish as they were to begin with. Okay, so this is the market participants. And so I'm starting to see these move lower. And so we had the top, and now we're moving lower. So I would expect at this point to start seeing prices moving lower as well, because we had high bullish activity and sentiment, and so that's bearish for the market. All right, next one up is the AAII. And as you can see, we had an increase in the bullish sentiment here and a decrease in the bears. But overall, when you look at the ratio here, the bull-bear ratio, you want to see extremes on this reading. And a reading of 1 is about as neutral as you can get. And that's exactly what we had last week on last Friday when I reported. This week, we're slightly above 1, but I would say overall that this is really, we're looking at neutral sentiment activity. We do have more bulls, so I would say, okay, maybe it's a somewhat bearish in the fact that the bullish sentiment is starting to increase. All right, next one up, name exposure index. So the active investment managers all get to put in how exposed they are to the market currently. And with high exposure, what does that tell you? That tells you that they are very bullish. Now, when you start to get these extreme readings, that's when you start looking for those reversals. And as you can see, in almost every case, we saw prices moving lower after, really high spiky readings to the upside, real climactic readings to the upside. There are a few exceptions. This would be one, I would say, only we did move sideways for some time, but that was an extremely high reading. I would have expected more of a downturn there, but we didn't get it. But in general, you're going to see a little bit of a drop coming in, or some consolidation when you get these extra high readings. It took some time in late 2017. We had the highest reading ever at the end of 2017, and we were in the midst of getting into that parabolic rally, but we still saw a continuation of that. But we saw almost the next week, they pulled back exposure so far at the end of 2018. And that should have given us a little bit of a clue at that point that we could be looking for some trouble coming up in January, February, which is, of course, what happened. But a lot, some of the times, these are the big guys. They tend to know what they're doing. So a lot of times you'll get these high readings, and it might take a little bit of time before they take effect, so to speak. But I would have to say right now, we did move up higher. You can see that it is not among the very highest readings, but certainly on the high side. So I would look at the name exposure as, an elevated reading. And I would say that that is bearish for the market. So I would expect a little bit of downside going into next week if I based it on what the name exposure is. Next one up is the Ridex ratio chart. Ridex is a company that used to manage these funds. They're now managed by Guggenheim, but we kept the Ridex name because we still, it's the same basket of funds that we use. There's bear funds, there's bull and sector funds, and then we log the money market assets as well, because all of those are reported to us every night by Guggenheim. And so by following those assets, we can tell where the money is going. It's not just a poll. It's not just somebody sticking their finger in the wind and saying, I feel bullish, and then they go out and sell all their stocks. So this is telling us what actually is going on as far as cash money goes. And so I think that this chart is generally has a little bit more weight on it than the just the polls do. So what is this chart telling us right now? Well, what it is telling us is that we are still seeing a rise, an overall rising trend as far as bear index fund assets go. And we are seeing an increase, especially since I think it was Tuesday on up, we're seeing an increase in the money market assets as well. But what's going on with the equity funds, the bull and sector funds? Not much. Assets aren't changing so much there. So what does this tell us? Well, there's an increase in bearish sentiment to the short side even, because the bear funds are getting an increased look. And then we also are seeing that increase on the money market funds as well. So these are some things to keep in mind. That tells us that participants right now are feeling more bearish. And what does that tell us? That's actually good for the market. That would tell us that we should start expecting, some upside movement. When you look at the Ridex ratio, and this is a bear-bull ratio, and I have inverted this scale also because, again, I want oversold near the bottom, overbought near the top. And that's exactly what happens when you see lots of bull assets in that denominator. The bigger that number gets in comparison to the top, the numerator, the smaller and smaller that number gets. And so the more bullish people are, the higher the ratio will go on this chart because it is inverted. And so that's, again, one of the reasons I do that, because my brain looks at indicators as oversold on the bottom and overbought on the top. So right now, I'm looking at this. Remember, we've got that increase in the bears, not much in the equities. And where does that put our ratio? That puts our ratio near the bottom of this band that it has been in since May. And again, that is considered bullish as far as what's happening with the money. All right. Let's look at our climactic indicator chart. And this one, I think I'm going to start including every day at the end of our final market update, because I think it gives us some very interesting information for the next day or two. This chart I look at for the very, very short term. And I was talking on Wednesday when I did my DP alert in my blog that we had a selling exhaustion that had lined up. And with a selling exhaustion, of course, that means you should expect some upside over the next day or two. And, you know, we got that mostly over the today so far, although as we looked at that final market update, we might be seeing lower prices, but we did get higher prices yesterday off of that selling exhaustion. So I thought that was interesting. And I just wanted to note how these can work as far as in a way, looking at it as somewhat as a sentiment chart. But the main sentiment portion of this chart is the VIX. And I follow where the VIX has these penetrations of the upper and lower Bollinger Band. And again, scale is inverted because oversold as far as sentiment would mean higher VIX numbers because people are feeling more bearish, correct? And so when they're feeling more bearish, that is considered bullish in the very short term as far as sentiment is concerned. So high numbers are actually good in the very short term as far as the VIX, and low numbers are bad because people get too complacent, too bullish, and then that's when you start seeing the downside reversals occur. So I wanted to show you that right now, VIX is sitting pretty much on its average right now. So it's not telling us a whole lot. And currently, you know, given what our yesterday's readings were on the advanced declines, they're not telling us much either. The only thing I could really point to when I look at this chart is sort of the decline in new highs. But we're also over the last 2 days, we're starting after yesterday, we're seeing at this point anyway, a decline in the new lows. So again, I think this is a fairly neutral chart right now, but we'll keep an eye on it for you during the Market Watchers Live updates. All right, so here is gold. And as you can see yesterday, it broke down out of this symmetrical triangle, or if at one point I did have it sort of looking like a descending triangle. And of course, that is not a positive situation. You know, I've been bullish on gold. We had that nice PMO buy signal that came in. We had very bearish sentiment on gold when you looked at the discount premiums on the Sprott Physical Gold Trust. And, you know, we have these high bearish readings. It just makes sense that we should see this rally coming in gold, and it just never really materialized. We ended up spending the majority of September moving sideways for gold, despite a really nice setup. I wanted to point out, though, that we still are seeing some highly bearish sentiment here when you're looking at those discounts. So I would start to, you know, I still am feeling like you should expect something good out of gold based strictly on the sentiment. But now, as you can see with the PMO, it has topped and is turning lower. So let's see, what did we talk about today during our sentiment update? So the 10-day moving average of the put-call ratio was overbought and declining, so that's somewhat bearish for the market. As far as AAII, we saw a slight increase in the bulls, but remember that bull-bear ratio was near 1. So overall, I'd say that chart is showing neutral for the market. We saw an increase in exposure for active investment managers, and you know, it was a high reading as well. So I would look at that as bearish for the market going in. And then we also looked at today the RIDEX ratio. And right now that chart is certainly bullish for the market as far as what we're seeing on activity as far as assets go. And as when we look at the VIX, you know, we had the earlier selling exhaustion that came in on Wednesday, saw prices rise yesterday, but now it's sitting, the VIX is sitting on its average. So it's really not telling us much. Unfortunately, that chart is neutral. Gold sentiment is still highly bearish, but it really hasn't helped. Gold is really trying to break down right now. All right. So in conclusion, there were very mixed readings. You know, our polls are suggesting bullish participants, but money is suggesting that they're bearish. So overall, I would have to look at it neutral for the market, but honestly, I would lean a little bit bullish at this point going into next week, mainly just because of where the money is going. And that is that people are bearish as far as where the assets are for the bear funds and the money market funds. So when I look and think about that, it does make me feel a little bit more bullish. I have to take a look at my indicators. I didn't get a close look at them, so that would help as well in my figuring out where I stand overall. But neutral for the market as far as all of those sentiment charts are concerned. All right, so let's pull up that poll, Tom, and I'm going to nudge you and make you think and talk. And let me know what you are thinking for what's going to happen with the S&P next week. And I know you usually look at it from a seasonality perspective.
Yeah, it's going to be hard for me to be bearish simply because we have pulled back. I think the market's still pretty healthy. And last week, I think the Dow, we had seen the RSI on the daily chart get up into the upper 70s, and that's now pulled back. I think it's now down around 62 or 63 or something, so it's no longer overbought. Same with the S&P 500. I think the RSI there had gotten close to 70, and now that's pulled back. And, of course, we've seen quite a bit of selling in the small caps, and they seem to be recovering today. We'll see whether or not that continues to hold up. I'm going to go higher, though, because I do think that the first several days of a calendar month tend to, you do have money flows coming in. And I just think the market is set up to bounce, at least to go back up and test those recent highs on the Dow and the S&P 500. So I'm going to go with higher.
All right. And you know what? I think I'm going to do the same. I just took a look at my short-term indicators chart, and they are oversold. They're still declining, but they're oversold. I would expect to see a little bit of a bounce going into next week. So I'm going to say higher. And it looks like most, well, I won't say most, half of you are in agreement with Tom and I. But we have a pretty sizable amount who are saying lower going into next week. So it'd be interesting to see how we finish out, whether we're correct or incorrect. I'm not really sure.
Yeah.
But
yeah, I was just going to say, we ended the second quarter on the S&P 500 at about 27 and a quarter. I think actually maybe just a little bit below that. And now here we are almost at 29 and a quarter. So we've had a really big move over the summer months, which is unusual. Market doesn't usually do very well July, August, September combined, but we've had a pretty nice run here on the market. And I kind of believe, and I think maybe one of our guests that we just had on recently, I think, was alluding to that. When you're getting strength during periods when you don't normally see strength, you got to kind of view that as bullish. I think it might have been Tom McClellan when he was on, but anyhow, I do find that bullish that we went up during the summer months where typically we're going to pull back. So I'm going to stick with my bullish call for next week.
All right. That sounds like a plan.
Yep. And we also have earnings coming up, by the way, too. They start in a couple of weeks, and it's not unusual at all to get a nice run up into earnings.
Yeah, that makes sense. That absolutely makes sense. So yeah, we'll have to see. I know a lot of people were, and I'm sure you're going to talk about it on Monday, but a lot of people have been thinking, well, September wasn't that bad. The expectation had been that we'd have, a really rough month, and it didn't really materialize in that way. And, we'll have to see what October, will we have to see bad news in October, but it sounds like we should be all right.
Yep. Well, that threw me off. The seasonality in September definitely threw me off. I got out of some trades too early. But anyway, I do want to thank everybody for being with us today. Please remember to complete that survey as you exit. We'd love to get your feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, everyone. Enjoy your weekend. Be safe, and we'll see you back here on Monday. Happy trading.